Alphabet Q2 2026 earnings breakdown. Let's get right into it. Alphabet just delivered a huge AI-era earnings signal, but the real story is the battle between Google Search and Google Cloud. Search grew 17%, while Cloud exploded 82%. So which business is really driving Alphabet's future? All right, let's look at the big picture. Alphabet just raked in a massive $119.8 billion in Q2 revenue. That's a 24% jump year over year. We're talking broad, across-the-board scale here. Operating income hit $40.8 billion, a 30% spike. That means their profits are actually growing faster than their revenue, which is exactly what you want to see. Now, they did report a diluted earnings per share of $9.11, but hey, quick pro tip for the beginners out there, be really careful just glancing at that headline EPS number. Their net income got a pretty big one-time boost from equity security gains this quarter. So, to really gauge the actual health of this machine, we've got to look under the hood directly at their core operations.
And when we do that, we're looking at two entirely different financial engines. Google Search brought in $63.3 billion, growing at a solid 17%. Meanwhile, Google Cloud generated $24.8 billion, but grew at an absolute explosive rate of 82%. You've basically got Search acting as this mature, gigantic advertising cash cow, right? Right alongside Cloud, which is a hyper-growth, momentum-driven infrastructure play.
Section 1. Google Search, the core cash engine.
So, the absolutely crucial point here is that 17% growth figure. Now, I know 17% might sound a little small compared to 82%, but you have to remember the massive base it's growing on. A 17% increase on a business that already does over $63 billion a quarter, that literally adds billions of dollars in new, real revenue. It's economically huge. It clearly proves that, despite all the noise and panic in the market about new technologies, Alphabet definitely hasn't seen any sort of major advertising collapse yet.
But of course, that brings us to the big question on literally every investor's mind. Will AI overviews disrupt traditional search economics? Look, management is out there saying users are absolutely loving the integrated AI mode experience. The bull case here is that AI increases the number of searches people actually do, improves their commercial intent, and ultimately creates better, more targeted ad opportunities. But the bear case? Well, if users get all their answers directly from a neat little AI paragraph right at the top of the page, they aren't clicking on standard links. And if they don't click on links, they don't click on ads. For those new to the stock, the key is to separate usage from monetization. People using AI more does not automatically equal more profit for Google. We have to watch closely if advertiser demand actually holds up through this entire transition.
Section 2. Google Cloud, the momentum story.
Now, what's really fascinating here is the profitability. Revenue surging 82% is fantastic, no doubt, but cloud operating income just surged to $8.8 billion. That is up massively from about $2.8 billion just a year earlier. Guys, this is a critical signal for the stock. They aren't just out there buying market share with low-margin, unprofitable sales. They are successfully scaling highly profitable AI computing infrastructure, data analytics, and massive enterprise services. To truly understand where this cloud business is heading next, we need to look at something called the backlog. Let's clearly define this for anyone who's new to tracking corporate finance. Backlog simply means contracted future revenue that a company expects to recognize as services are delivered over time. Just think of it as guaranteed, legally binding money in the pipeline that just hasn't hit the quarterly revenue sheet quite yet. And this is exactly why that definition matters. A staggering $514 billion cloud backlog gives Alphabet massive, long-term visibility into their future revenue. It shows us that major enterprises are locking into massive, multi-year contracts for Google's AI models and cloud services. Management even noted that demand is remaining incredibly strong while supply constraints still persist. So yeah, the enterprise market is officially hungry for this. If you're finding this Alphabet earnings breakdown useful, subscribe, share, and like Fox of Wall Street for more U.S. stock market and earnings analysis.
Section 3. The AI spending risk.
Which brings us right to CapEx, or capital expenditure. Simply put, this is the money spent by a company to buy, maintain, or improve fixed physical assets. In Alphabet's case right now, we are talking about building massive AI data centers that consume literally as much power as small cities, completely packed with highly specialized chips. And that leads us to this jaw-dropping raised outlook for 2026. $195 billion to $205 billion in projected CapEx. This right here creates a classic high-stakes investor trade-off. If they spend too much, it severely depresses their near-term cash flow. But if they spend too little,
Well, they physically won't have the compute capacity to keep growing that cloud business we just talked about, and demand is already outpacing supply. It's an absolute high-wire balancing act.
This colossal spending directly impacts our next vital term, free cash flow. This is simply the cash left over after a company pays for its day-to-day operating expenses and those huge capital expenditures we just defined. Ultimately, free cash flow is the true measure of whether all this wild AI spending is actually creating real, usable, bottom-line wealth for the shareholders.
So here's the exact cycle of how this works in the real world. It all starts with massive upfront AI investment. That money builds the physical infrastructure and the data centers. That infrastructure then powers the cloud and AI products they sell to enterprises. Those products generate revenue. That revenue eventually turns into operating profit. And finally, after all the massive bills and capex are completely paid off, it hopefully drops right down to free cash flow. As an investor, you want to see this entire chain operating smoothly and efficiently, without breaking down at that final, crucial step.
So where does all this leave us? Let's objectively lay out the two primary scenarios playing out in the market right now. The bull case assumes search remains incredibly resilient, AI actually improves their ad monetization, and cloud continues to sustain its strong growth, meaning Alphabet earns a fantastic return on all those expensive data centers. But the bear case? That argues AI directly disrupts traditional search clicks. Cloud growth normalizes and slows down sharply, and that $200 billion capex plan results in much lower than expected returns, making the stock's valuation a whole lot harder to defend.
To figure out which side is actually winning, beginners and seasoned investors alike need to track exactly 4 metrics next quarter. Number 1, search growth. Is it sustaining mid to high teens even as AI overviews expand? 2, cloud growth durability. Does it stay significantly higher than overall Alphabet growth as the revenue base gets larger? 3, cloud margin. Are they absorbing those massive infrastructure costs efficiently and still growing operating profit? And 4, capex compared to free cash flow. How much actual cash is really left in the wallet after this historic AI spending spree?
Alphabet's biggest question is no longer whether it can grow. The question is whether it can turn massive AI demand and massive AI spending into durable free cash flow and high returns. That's what investors should watch next.
This explainer is for educational and informational purposes only and is not financial advice or a recommendation to buy or sell any security.